You're missing out if you've never heard of Charlie Munger. If not for Warren Buffett, Munger would probably be the most well-known investor in the world. For nearly 4 decades, Munger has been Buffett's closest business partner and right-hand man, and he has played an important role in building Berkshire into what it is now, a $700 billion company. Today, we are going to fill you in on the wisdom of Charlie Munger. Sure enough, you can make yourself financially secure and wealthy if you listen to what the billionaire has to say. 1. Exploring new ways to earn more. Usually, people want to bolster their finances, trim their expenses. But cutting costs only goes so far. Unless you already make a lot of money and spend like a bon vivant, most people can't eke out that much more from their budget by decreasing expenses. Plus, the more you retrench, the more your quality of life suffers. It's all relative though. Certainly some overspenders could actually improve their lives by tempering their expenditures. Changing your job is the best way to boost your earnings, as you have the most leverage at the moment that a company wants you but isn't sure whether it can get you. Use that to your advantage in negotiations. Another benefit of getting a bump up when you switch jobs is that the percentage boost will be baked into all your future raises, elevating your lifetime earnings. Getting a raise is an excellent move because it doesn't require you to trade more time for more money. You're putting in the same amount of time, but pulling a bigger paycheck. But it's always a bit tricky to ask for a raise when your company already has you at your current salary. You've got to make a strong argument you deserve the increase. Freelancing is the next best thing to being paid more for your full-time work, because professional work always pays more than unskilled. To find opportunities, let former colleagues or other personal connections that you're available for freelance gigs. If you have enough experience in your field to coach others with their careers, then create a website, or if you have one, add a section describing what you'd offer as a coach. Advertise your services in industry forums and give new clients a discount or other incentives to refer you. 2. First $100,000. Financial stability and financial goals are 2 key reasons for saving. Financial stability and planning helps provide confidence in your abilities to pay unexpected bills, fund your own retirement, and maintain a desired lifestyle. Goals can also help to look towards the future and keep saving efforts in check. The more money you have to save, either from reduced expenses or increased income, the faster you can move towards accumulating your first $100,000 for any goal you may have in mind. And once you do that, the way to the next $100,000 becomes easier. For many people, saving your first $100,000 is not necessarily a short-term goal, but you're trying to stash away $100,000. To get there, you need to train your mind. Keeping your particular goal in mind can help, but you can also need to understand how to achieve your goal with a plan. If you are the kind of person who rarely budgets or takes notes of expenses, now would be the time to start. Budgeting will help your mindset. Build a budget that is oriented towards achieving your goal. Keep in mind that little things can add up. When you found a few ways to save a little more and made a budgeting commitment on how much you plan to save, you'll want to make sure those funds are invested efficiently. Working with a financial professional or delving deeper into resources that help you do the investing yourself can be good ideas. In the process of budgeting and building out a financial plan, mapping out the present value and future value math will also be helpful. The path to $100,000 is inevitably longer than the path to $10,000. This can at times be somewhat overwhelming, so short-term goals can be very helpful. Moreover, do the math. Knowing that $1,000 savings per month can get you to $100,000 in 6 years can be very motivating. This motivation can help to make sure you stick to your budget and skip over the new BMW. Incoming revenue is the other key component of your personal budget. Finding ways to generate more revenue will also help you reach a $100,000 goal faster. Don't let any of your skills or talents go to waste. Your spare time can also be very valuable. 3. Own equity. Equity is just a fancy word for owning a piece of a business. You can get equity in a few different ways. You can own equity in a business that you start. You can own equity by buying a piece of a publicly traded company, a stock on the open market. You can own equity in a startup company that you invest in privately, for example. You can own equity in a product or a piece of intellectual property or IP, like a book, script, or other artwork. Equity, typically referred to as shareholders' equity or owner's equity for privately held companies, represents the amount of money that would be returned to company shareholders if all of the assets were liquidated and all of the company's debt was paid off. When you own equity, You have a right to the assets of the business. Your piece grows as the business grows. Those who are already rich take equity very seriously. When you own a piece of a business, the business compounds your money by reinvesting any interest or earnings it generates to create even more gains on top. So, not only are you compounding your initial investment, you're also compounding all the interest or earnings you accumulated in the past. When you work a salary job, paid by the hour or by the year, your input, or 8 hours a day, is directly connected to your output, your salary. Equity severs this relationship. For example, if you're an investor in public companies, you could spend 1,000 hours input researching one publicly traded stock to buy. Then, when you buy it, your return could be 0 or even worse. You've done a bunch of work for free. You don't even have to be awake and working to make money. All of your gains could occur while you're asleep. When you own equity, you decouple the outputs from the inputs. Equity gives you unlimited upside. When you work in a salaried position, your upside is limited to a yearly salary or an hourly rate. Sure, you may get a nice bonus at the end of the year, but ultimately, your upside is capped because the input, the hours you put in, matches the output, your hourly wage. There's no additional upside potential. Owning equity in a business means that there's no cap on your upside because your piece of the pie grows at the same rate as the business. 4. Spend wisely. When you get a gift voucher, you don't spend too much time thinking about the best ways to use it. All you want is to quickly utilize a voucher. Unfortunately, most people treat their paychecks the same way. Even before their salaries reach their bank accounts, plans to blow it away have already been finalized. The dangerous combination of promotional advertising, peer pressure, and personal aspirations is compelling them to satisfy their wants and sacrifice their needs. Spending your hard-earned money is not a vice. To some extent, it is also essential because it helps us maintain the quality of our lives. But there is a difference between spending for living a good life and spending on things for instant gratification. While we need to spend on essentials like food, clothing, and other things, we also need to think of how to improve the future quality of our lives. If we can draw a line between spending and spending wisely, we can make better choices. For example, you can spend time watching television or reading a good book. Watching television will bring you instant gratification, but investing in a good book may make you richer with knowledge and add to your skills. We also need to distinguish our wants from our needs. A car can be both a want and a need. If you buy a modestly priced car for going to work or traveling with your family, you are satisfying a need. But if you buy a costly SUV to show off, then you are giving in to a want. Mind you, a car is a depreciating asset and its value comes down the minute you drive out of the showroom. Prudent investing should be a conscious choice for the young generation. It can transform their financial future and make them free from money problems. Good investments appreciate in value over time, gaining from the power of compounding over the years. Some have even called compounding the 8th wonder of the world. So, if you want to get rich, start keeping a check on how you spend your money. 5. Diversification. Diversification is a technique that reduces risk by allocating investments across various financial instruments, industries, and other categories. It aims to minimize losses by investing in different areas that would each react differently to the same event. Most investment professionals agree that, although it does not guarantee against loss, diversification is the most important component of reaching long-range financial goals while minimizing risk. Here, we look at why this is true and how to accomplish diversification in your portfolio. Diversification reduces risk by investing in vehicles that span different financial instruments, industries, and other categories. Unsystematic risk can be mitigated through diversification, while systematic or market risk is generally unavoidable. Investors can choose to pick their own assets to invest in. Otherwise, they can select an index fund that is composed of a variety of companies and holdings. Balancing a diversified portfolio may be complicated and expensive, and it may come with lower rewards because the risk is mitigated. A diversified portfolio may lead to better opportunities, enjoyment in researching new assets, and higher risk adjustment returns. Diversification is thought to increase the risk adjustment returns of a portfolio. This means investors earn greater returns when you factor in the risk they are taking. Investors may be more likely to make more money through riskier investments, but a risk-adjusted return is usually a measurement of efficiency to see how well an investor's capital is being deployed. Some may argue diversifying is important as it also creates better opportunities. In our example above, let's say you invested in a streaming service to diversify away from transportation companies. Then, the streaming company announces a major partnership and investment in content. Had you not been diversified across industries, you would have never reaped the benefit of positive change across sectors. Last, for some, diversifying can make investing more fun. Instead of holding all of your investment within a very small group, diversifying means researching new industries, comparing companies against each other, and emotionally buying into different industries. We hope this motivated you to stop being a cash potato and start working on getting yourself rich. If you like this video, please subscribe to our channel, and we'll see you in the next one.